So lately, both the media and traders have been absolutely convinced that a recession is going to happen next year in 2020. So in today's video, I want to try to give you an objective view of the entire situation and give you some reasons why it can absolutely happen in 2020, but also offer you some counter arguments to those claims as well, which by the way is something that the media never really does. They always seem to be on one side of the argument depending on what news outlet you're watching. So I want to try to give you guys both views, okay? And then at the end of the video, I'll also offer you my personal opinion as well, and then you can take that for however you'd like. But this should be a very fun video. I hope you guys enjoyed it. It took me a long time to do some of the research for this, so if you don't mind, please consider hitting the like button if you enjoy the video. It really helps support the channel, and maybe even share the video with some of your friends and family as well. But without wasting any more time, let's go ahead and get started and talk about the 2020 recession. What's up everyone, my name is Ale. Welcome back to my world of stocks. Okay, let's get straight to the point. People are convinced that a recession will happen in 2020, and one of the absolute biggest arguments for this is the inverted yield curve. So let's investigate that and take a little bit of a closer look. Well, before we take a look at the actual inversion itself, it's important to understand why an inversion happens in the first place. And what basically happens is that bond investors are making predictions that the economy is going to struggle in the future, and therefore the Fed will have to cut rates to kind of stimulate the economy. So they start buying long-term bonds right now to lock in the higher rates that they think will actually be lower in the future. And so what ends up happening is that demand for longer term bonds, like for example the 10-year treasury bill, the demand for them will go up, so the price goes up, and that brings down the yield. It's similar to like dividend stocks, right? If dividend stock prices go up, then their yields go down, and if the stock prices go down, then the yields go up, and it's pretty much the same thing with bonds. So you essentially have a situation now where short-term bond yields have been going up because of rising interest rates that climbed very quickly in kind of a short amount of time, and we'll take a closer look at that later in the video. But so you have kind of the short-term bonds, like maybe the 3-month to 2-year, things like that, going up, their yields going up, and then you have the yields for longer term bonds like the 10-year going down. And when the short-term yields go higher than the long-term yields, then you essentially get a inversion. And so the reason why that's important is because throughout recent history, whenever we have a yield curve inversion, you'll tend to get a recession within a couple years from that. So at the end of the day, it's basically bond investors predicting that we're going to have a struggling economy, something like a recession, and so the yield curve will invert. And if those bond investors are accurate in their prediction, which again throughout recent history they have been accurate, then you will essentially get a recession soon after. Now you could certainly ask the question, well, why should we even listen to bond investors in the first place? And that's a valid question, but the answer is, I think there's really kind of two answers that you could look at. For one, they have some pretty high accuracy, which we'll take a look at in a second. And then number two is that the bond market is so much larger than the stock market. And so whenever the bond market tries to give us a warning, we tend to listen to them, we tend to pay attention to them because they're so massively large. In fact, as recently as March of this year, Zacks Research estimated that the US bonds market was worth over $10 trillion more than the US stock market. And to be honest, I've actually seen other estimates out there that put US bonds at close to $20 trillion more, depending on the time of year and the current market conditions. So it's pretty crazy how much larger the bond market is. In any case, in previous videos, we talked about other parts of the yield curve inverting, like the 10-year treasury bond that fell below the 3-month just a few months ago, signaling a possible recession. As you can see on this chart here, previous inversions were successful in signaling recent recessions within a couple years following the inversion, so it's definitely a big deal. Now, things get a lot muddier the further back in history that you go, but again, recent recessions have been signaled pretty successfully. On the other hand, many economists would point out that an inversion has to last a full quarter before being used in most recession signaling models, and if we zoom in, we can see that it was positive around the end of July, so it has technically been negative for only around a month and a half. However, if you exclude that date, then it has actually been inverted for close to a quarter's worth of time, and that's not a good sign. But that's not even the inversion that everyone has been screaming about lately. That honor goes to the benchmark 10-year minus the 2-year curve, which is famous for accurately predicting every recession over the past 50 years when it inverts for at least 3 months. And you can see some of that on this chart here. But to be fair, there are a couple of notable issues that should be taken into account as well. For one, if we zoom in on the present, you'll notice that the inversion has only recently lasted a few days, and it wasn't a very large inversion to begin with either. That's important to note because, as the Hill points out, quantitative easing and artificial distortions have pretty much removed the term premium that long-term bonds used to hold on their yield, so many would argue that the inversion needs to be deeper to compensate for the fact of lowering long-term yields if you really want to accurately signal a recession. You also have to keep in mind that over the past decade, we went through many years where interest rates were artificially kept low, and only recently the Fed decided to start raising rates very quickly over the last few years. So many would argue that the Fed rose rates too quickly and too suddenly, which, by the way, it only has an immediate impact on the short-term rates, and that caused the short end of the yield to rise, while the lack of a long-term premium caused the long end of the curve to actually drop, and an inversion was bound to happen. In fact, Janet Yellen, who was the previous Fed chairman, even warned about this back in 2017 when she basically told everyone that the inversion was inevitable given the flatter curve and low premium. I'm obviously inferring here, but I think that it's a reasonable assumption based on her choice of words. In any case, I personally think that the longer end has come down even further because of the fear coming from the trade war between the two largest economies in the world, in the US and China, which may or may not be justified depending on how you think that will all play out. But add to that the fact that we are seeing a global slowdown with 9 major countries almost in recession, and the UK trying to leave the European, or I should say 9 major countries already in or heading into a recession, and the UK is also trying to leave the European Union, and you're basically left with a perfect storm of pessimism that understandably crept into the bond market when trying to predict the foreseeable future. Obviously, they're going to think that the risk of a recession is rising, and that's an understandable assumption. And to kind of put a nice bow on all of this, if we look at the yield charts specifically for the different bonds, we can see that the 3-month bill completely correlates with the recent rise in interest rates over the last few years, and the story is exactly the same with the 2-year bond as well. However, when we look at the 10-year bill, the chart looks completely different and correlates much more closely with fears that we saw in 2016, at the end of 2018, and during some of this year as well. Also, if we zoom out, you can see that the 10-year yield has been dramatically declining over time, and that also correlates with the drop in the 10-year premium, which you can see on this chart right here. So it makes complete sense that an inversion was very likely to happen, and while the reasons for concern are absolutely justified, maybe the argument that it should be a deeper inversion is also somewhat understandable. Obviously, there are many reasons why you should take a yield curve inversion very seriously, and the last 50 years of correct signaling for recessions is absolutely a big reason why. But do I think that the yield curve is the end-all be-all? Well, I don't really think so. In fact, I think that a lot of people actually follow the yield curve a bit blindly without paying enough attention to the actual macroeconomy or the fundamental issues of our economy. Instead, they just kind of want like a magic 8-ball to tell them when to sell out of the market, and so they treat the yield curve in that same way. But here's the thing, even if this time is not different at all and the signal is 100% correct, the recession can still be another 2 or 3 years away, and during that time the market still rallies by 15% on average following the recession. But again, I come back to the fact that people look at the inversion without even really caring about the macroeconomy, and this is where we start to really see some deep issues not just internationally, but also here at home as well. For example, my personal biggest fear is our rising debt levels, as the US national debt has reached record highs of over $22.5 trillion, which is double what it was a decade ago, and that only continues to get bigger as we do bring in 3.5 trillion in taxes, but spend even more at 4.5 trillion on our budget, leaving us with a yearly deficit of over $1 trillion every single year. And corporate debt looks just as ugly, as that's ballooned to almost $10 trillion, which is around 50% higher than it was a decade ago. But on the other hand to all this, there are also a few positives that I think should be considered as well. For one, consumer spending makes up the majority of our economy, and as of right now, it's still very high, right along with consumer confidence. And this is during a very heated trade war with China. And the reason why the consumer is so strong during difficult times is likely due to unemployment rates being at some of the lowest levels in history, while wages are also increasing at some decently high rates as well, meaning that all of this consumer spending, which again is most of our economy, should be sustainable if things were to stay relatively the same. And while I do think that the average consumer debt is very high, it's actually been shrinking as a percent to GDP, which was much higher before the last recession. And internationally, we already have extremely low interest rates, if not negative interest rates, that keep going lower in many countries, but those lower interest rates can't solve the problem all on its own, so they need help from fiscal stimulus and possible tax cuts, which is what we're seeing in different areas like Europe and China, for example. So if those plans were to help international economies, that would be a very positive thing. And speaking of China, what if we actually get a beneficial trade deal? I know that a lot of people don't think that we'll get a deal done anytime soon, because things have been looking, very poorly recently. But if we do actually get a beneficial trade deal, then you could be in a situation where we no longer have these massive tariffs, and all the meanwhile, the Fed is cutting rates, and we still have very low unemployment with high consumer spending. Not to mention that technology is really on the rise right now, which is something that nobody ever really talks about, but you have markets that could potentially do very well in the kind of near future, areas like 5G, artificial intelligence, machine learning, the Internet of Things, and so on. And I think a lot of these companies really want to dominate these markets, so I don't really see them kind of cutting their spending. They'll probably have to increase spending on, CapEx and reinvesting on innovation and growth and different things like that. So that could also add some further growth as well if the economy doesn't really tank into a recession. And by the way, as much as people like to say that this expansion has gone on for far too long, you have to also consider that our growth is much lower than it has been in the past, but it's almost like a trade-off for having longer expansions, which some people would argue is not such a bad thing to kind of trade, not having like really high growth, but your expansion can last a bit longer as well. Some people think that that's not such a bad trade-off. So what if we're left with a situation where maybe we don't have a recession in 2020? My only point is that there are so many factors involved, both horrendously bad and some optimistically good, that it's really impossible to accurately predict when the next recession will actually take place. Unless, of course, the yield curve inversion is accurate in predicting a recession once again, which is a very high probability, but that would also be you would also have to take into account whether the changes that I mentioned earlier to the yield curve don't actually impact its ability to predict a recession. And that is kind of a big if. But if things are really not different this time and everything's the same and the yield curve inversion is accurate once again in predicting a recession, even then you're still talking about up to 2 or 3 years before the recession actually takes place. So at the end of the day, nobody really knows exactly when that's going to happen, but in my personal opinion, and I hate to do this, but if you really force me to give you a prediction on what's going to happen, my gut feeling, because again, I have no idea what's going to happen, but my gut feeling is that I think a trade deal will get done with China within the next year. And I think that because we have an accommodating Fed, I think that those two things will kind of push our expansion a little bit further. Now, the reason I think that is because I think both sides really need a deal. I think President Trump needs it for the next election, and I think China needs it because of their struggling economy and protests and all kinds of issues that they have going on. So I think both sides kind of give a little, kind of take a little. They go back to their sides. They both claim victories, and we could potentially progress here with maybe a decent deal with China and also an accommodating Fed. And with all of that, and also kind of low unemployment rates and also high consumer spending, it is so hard to go into recession when you have all of that, all of those kind of tailwinds. So anyway, that's just kind of a gut feeling. I know a lot of people will hate that prediction because, and I'm not trying to throw shade on these people, but I know I have a lot of kind of perma-bear viewers who always think that the market should just kind of crash, and they always think that we should be in a recession. And I'm not trying to throw shade on them. And to be fair to them, I actually think that the risk of a recession has been increasing every single year. And when I look at the global macroeconomy and when I look at the Brexit situation, there's so many issues out there, and especially our debt levels, which is my biggest concern. I think we absolutely will have a recession sometime soon. If I had to make a prediction about 2020, I just don't think it's going to be 2020. That's just my gut feeling. And anyway, that's just how I feel. But let me know what you guys think down below. And I know that this is a touchy subject, but if you did appreciate the video, please, again, consider hitting the like button and maybe sharing it. And by the way, if you're wondering what I'm doing personally to prepare for the next recession, what I'm trying to do is I'm trying to build up a cash position. So in my stock portfolio, about 40% of it is actually cash equivalents, so that I can take advantage of the next recession and buy some stocks at some very low prices. Now, one thing that I do want to address is that I recently had a conversation with one of my favorite viewers, a really great viewer. His name is Scott. You guys probably know who I'm talking about because he leaves comments all the time and leaves some really detailed, very amazing comments. And shout out to Scott, by the way. I hope you're having a great day. So, but he brought up a very, very great point, which is that during a recession, you could go through economic hardships yourself. Maybe you lose your job. A lot of people do during a recession. So even if you're saving money, you might actually have to use that money. First of all, a lot of people don't even save money. And even the ones that do, they may have to actually use that money during a recession for other reasons. So my only kind of counter argument, which it's not a point that I'm arguing with. I actually agree with him, but my only kind of counter argument to that, I guess, would be that, or my advice would be to those people that you should always be saving money. Okay, so not just in stocks. For example, when I look at my stock portfolio, out of my monthly budget that goes into stocks, like half of that goes to the cash portion of my portfolio, and then I'm only buying stocks on down days when the market panics and when stocks dip. So I'm still buying stocks, but I'm putting like half of that budget into the cash portion, so that I can take advantage of the next correction or market crash. But outside of that, I also save money as well. And I think a lot of people should be saving money outside of that too, so that you can kind of survive if God forbid, you actually lose your job or something like that, something very horrible happens, you have some savings as well. Now, on top of that, you should always be working very hard to get a very stable and secure job. And even when you have one, you should be working very hard to kind of move up so that you can earn more money and save more and invest more as well. I know that's very common sense, but sometimes you just kind of need a reminder to really push harder and to try to achieve more in life. But as far as how those people will be able to survive the next recession, or how they'll be able to take advantage of lower prices if they were to lose their job and stuff like that, I mean, those are just situations that I can't really speak to. I mean, it's a case by case, scenario. Some people will lose their jobs, some people won't lose their jobs. Some people will have money to invest in stocks, some people won't. And for me, I know I have a really good degree. I have a really good job that is in very high demand. And I'm not talking about YouTube. So I'm in a good situation for myself. But, and all I can do is really just kind of hope that you guys are as well. But I know that some people just won't be, because it's the reality of the situation. Now, you could also make the argument, however, that because of that fact, because of the fact that during a recession you could go through economic hardships, all of the perma bears, and again, I'm not trying to throw shade at them, but there are absolutely perma bears who have every year for the past decade been predicting recessions and market crashes, and they just always seem to think that things need to get worse. Now, first of all, those same people are the last people that will be buying during a recession, because they always think that things will get worse and worse and worse. However, even the ones who will actually try to take advantage of that what if they happen to lose their jobs, or what if they happen to go through economic hardships? So not only are they in a situation where for the past decade they've been, maybe not the whole decade, obviously I'm kind of speaking broadly here, but for a lot of this time that we've been going through a huge economic expansion, or a decent economic expansion, and we've had the stock market reaching record highs, not only have they not been taking advantage of that, leaving a ton of money on the table, not taking advantage of that, but now they're going into a recession because they think that they can take advantage of that. They think that they've been saving all this time and now they're going to buy all these amazing stocks at great prices. What if they lose their job? What if they go through some economic hardships and they can't even take advantage of that? Then they're in a situation where they missed out on the entire, past decade, and then now they're missing out here as well. So it's like, at what point are you just gonna swallow your pride and just go out there and just buy some damn stocks for the long term, But maybe this is, again, the debate that we keep coming back to of long-term investing versus short-term trading, trying to time the market versus just buying good companies at reasonable prices for the long term. It's absolutely an argument, and I can see the point of view from some short-term traders who try to predict the market. But if you're going to be on that side, just make sure that you actually can take advantage when the market really corrects or crashes. Make sure that you are in a situation where you really can take advantage, and then I think maybe you'll do okay. But anyway, I'm a long-term investor, by the way, so I'm just kind of I've already kind of explained everything. I don't want to drag the video on longer. I can tell I'm already rambling. So anyway, I hope you guys enjoyed the video. Really means a lot to me that you guys clicked on it and watched it. I really appreciate it, and I'll catch you guys in the next one. I wish you all the best with no matter what happens in 2020 and into the future. I really hope that all of you guys prosper and do very well. So anyway, thank you for watching. I'll catch you guys in the next one. Take care. Bye-bye.